Hi everyone. In this recorded lecture, I will be taking you through the balance part of session 6, which is auditing accounts receivable and revenue. We started this session 6, this lesson, during the last physical lecture, but we have few slides remaining to cover. So, in this recorded lecture, I'll be completing those slides. Right. We have discussed the accounts receivable part. I told you we are going to talk about sales, that means revenue, and the other important balance sheet item or the statement of financial position item, accounts receivables, basically debtors, trade receivables, right? So, I explained you why revenue is very important in an audit and similarly why accounts receivable part, especially trade receivables part in accounts receivable part is important in different aspects, right? I'm not going to repeat myself, but I hope you can remember. So why audit risk is very high when it comes to revenue and accounts receivables? And then how do you assign the risk assessment? How do you basically assess the risk of this revenue and trade receivables? And what are the control environment, risk assessment, control activities? And then we discuss the revenue cycle. What are the documents we can have? Usually in a process, revenue process, I told you these documents would not be the same for all the organizations, but there can be differences based on the nature. And then this is a basic sales system. This is again not the exact system. There can be so many differences, so many additions, modifications in the real world organizations. But if you just draw a sales system, this would be like this. And then using flowchart, the symbols and all, also you can draw this one. You can have a look. And then we discussed how do you assess the risk of receivables. And we discussed actually one by one. This is basically application of the theoretical aspects we discussed during previous lectures. So understanding the client, understanding its environment, and identifying what are the inherent risks and whether there are any risks of frauds happening related to receivables and revenue. And then you need to understand the internal controls placed by the organizations over receivables and revenue, and then assess the risk of material misstatements. What is the risk of happening material misstatements in the revenue and other receivables? And you need to design the further audit procedures based on the assessed risk. So you know that as well. We discussed the metrics we can use. When the risk of material misstatements is high, how do you design more audit procedures? Likewise, we discussed that theoretical aspect. So same thing you can apply in this situation as well. And then we discussed this one as well, understanding the client's business. So what do you mean by understanding the client's business? These are the things when it comes to revenue process, the types of products, who are their customers, whether it is a seasonal or a cyclical demand. Likewise, different things you need to understand before you start the audit. Basically, you understand the whole process. So I told you this is, you call this system study. You study the system basically. You study the client. You study the environment. You study the internal controls. Basically, you study the system. System study. A thorough system study is required before you do any audit procedure. And then fraud risk related to receivables and revenue. Understand controls established by management to control risks and determine controls have been implemented. That means you identify or you understand whether the client has designed good internal controls. That's one thing. And then you have to determine whether those design controls have been actually implemented. Operational effectiveness. First one is design effectiveness, whether they have designed well. Second one, operational effectiveness, whether they are operating well. You need to have understanding for both. And then response to risk. Based on the understanding you got, now you respond to the risk. an overall effect on the audit. You need to decide, okay, based on the risk of revenue, based on the risk associated with trade receivables, what is the overall impact on the audit? And then alter the design of audit procedures. You may have decided to come up with or conduct the audit with 250 sample transactions. But with the risk assessment, maybe you will have to increase the sample. Maybe you will have to increase the number of audit procedures you follow, right? Performing procedures to address risk of material misstatements due to management override of internal controls. So we discussed management override as well. Sometimes managers do not care about the internal controls placed in the organizations. Even though internal controls are there, they are not actually following them. They don't take it serious. They don't support the internal controls. They just bypass the internal controls. So you have to perform additional audit procedures when you have situations like this. And then now, basically, we have selected revenue and trade receivables as an example, right? There are so many other PPE, inventory, expenses, cost of sales, other income, investments. Likewise, there are so many bank and loans and borrowings, cash and cash equivalents. Likewise, so many captions are there, right? But since we can't discuss all these captions in this course, we have selected revenue from the P&L and trade receivables from the statement of financial position side. So that's why we are taking only two. But since you study or when you study these two captions, you will have an understanding about other captions as well. So that's why we are taking only two, right? So here we have mentioned, actually the original documents are already uploaded to LMS. Potential misstatements. What are the potential misstatements you can find when it comes to revenue? So I'm not going to read all these things, but we'll take few. Description of the misstatement. What is the first one? Recognizing revenue not yet earned. That is one major potential misstatement organizations can have. What is that? They have recognized revenue not yet earned. Maybe there are no actual revenue transactions, but they have recognized them in the books. So that can happen. What are the examples? Recording fictitious sales without receiving a customer order or shipping the goods. You have not actually received a customer order for sales, but you have recorded a fictitious sales. Sometimes maybe the sales managers wanted to increase the sales just to show that the company is performing well, just to meet the targets, or just to get their bonus. Maybe because their bonuses are calculated on the sales targets achievements. So there can be different reasons. It is a fraud. Fraud means intentional. I hope you know the difference between fraud and error. Fraud is intentional. Error may be due to negligence. It is not basically intentional. There can be errors happening, right? But here, recording fictitious sales, that is a fraud, intentional. And intentional overshipment of goods. That means the sales order, there's a sales order says 50 units, but you are overshipping it. You know it intentionally. You are overshipping 70 items. So actually, after shipping, you can have some mechanism. You are sending only 50 items to the real customer, and you are taking that balance 20 for your own personal benefit, or you are selling it to someone else likewise. So these are the examples. So internal control weaknesses or factors that increase the risk of material misstatement. How these frauds can happen? What are the internal control weaknesses? Now, if the company has good internal controls, these frauds cannot happen, right? There's a less chance of happening these frauds. So why? What are the factors affecting this? Maybe ineffective board of directors, audit committee, or internal audit function. Maybe they are not doing their job very well. ineffective board of directors. Their top management is not supporting the internal controls. And then tone at the top, not conducive to ethical conduct, undue pressure to meet sales targets. Likewise, there can be different reasons why these frauds can happen in an organization, right? As I told you, their bonuses are calculated maybe based on the sales targets achievements. So they are pressured to record fictitious sales transactions. So these are the reasons you can have. We'll look at errors as well. When it comes to errors, now remember, errors are not intentional. Recording sales based on the receipt of orders from customers rather than the shipment of goods. Maybe the customer has requested 200 units, but when you actually make the shipment based on your stock availability, you are sending only 180 units. Why? You don't have sufficient stocks in the warehouse. So even though the customer has requested 200, you are sending, after communicating with the customer, you are actually sending 180. Now, when you actually record the sales, you need to use 180 units, isn't it? Not 200. But unintentionally, erroneously, you look at the sales order and record the sales transaction as 200 units, not 180. That is an error. That is an error. Maybe it is not intentional, but an error. Inaccurate billing and recording of sales. Billing inaccurately. Recording cash that represent a liability. That means receipt of a customer's deposit as a revenue. It is not, we have not provided the goods or done anything. Customer has paid an overpayment or advance maybe. That advance, now if we receive an advance, the double entry should be cash debit, advance credit. It's a current liability basically. But if we debit cash and then credit revenue instead of the advance, that becomes a revenue transaction. So likewise, those errors can happen. What are the reasons? What are the internal control weaknesses? Ineffective billing process in which billing is not tied to shipping documents, shipping information. So when you record the transaction in the billing process, you have not cross-checked all the documents. What is the sales order? What is the shipping documents? Likewise, you have not cross-checked the numbers. So that is one issue. There should be controls in an organization when you actually record the transaction, or when you print the invoice. You have to check the sales order. You have to check the goods dispatch note. Likewise, you have to check several documents, all the documents. So you have to match the numbers and then only finalize. If that process is not there, if that internal control is weak, there can be errors like this. And ineffective controls for testing invoices, or ineffective input validation checks and computer reconciliations to ensure the accuracy of databases. Basically, lack of reconciliations. If you reconcile, you will find out these issues. Inadequate accounting manual, incompetent accounting personnel. So if a person doesn't know how to differentiate a sales advance or a actual sales transaction, if the person doesn't know the double entries correctly, definitely there can be errors. So these are the issues, right? So I'm not going to go one by one. I'll just show you the misstatements. Likewise, recording, recognizing revenue not yet earned, or early or late recognition of revenue. That means cut-off problems. You have to record this transaction in 2023, but recorded in 2024. One date change, but the year is going to change with that one date. Or you have to record this in 2025, but recorded in 2024. Cut-off problems. We have discussed this cut-off issue, right, in the lectures. So cut-off issues can happen, not in the relevant period. Recording revenue when significant uncertainties exist. That means overestimating revenue by underestimating the effects of customers' right to return goods. There's a high possibility that the customer would return the goods, but you have not considered that uncertainty. Recording revenue when significant services still must be performed by seller. Recording franchise revenue when the franchises are sold, even though an obligation to perform significant services still exists. So based on the performance obligations, SLFRS 15, you have not fulfilled those obligations, performance obligations, but you have allocated money and recorded. Likewise, there can be issues. So for each and every fraud or error, based on whether it is intentional or unintentional, we can categorize the issues as frauds or errors, and then you can identify what are the actual internal control weaknesses. Overestimation of the amount of revenue earned. I'm not going to explain one by one, but these are the misstatements, potential misstatements. And then additional test of controls. Now, you're performing further audit procedures, right? You're performing further audit procedures. When it comes to further audit procedures, what are the examples of test of controls? What are the examples of test of controls? Examine significant aspects of a sample of sales transactions. Compare a sample of shipping documents to related sales invoices. You are testing the controls means, now we explained very well, a control can be there. A control can be there to match sales order, goods dispatch note when you actually finalize the invoice. That is the internal control in the organization. Now, what is the test of control? You are going to test that control. You are going to see whether that internal control has actually happened in the organization. You call it testing the control. So how do you test the control as the auditor? You go and see a sample of invoices or sample of sales orders, sample of goods dispatch notes. You get all these three documents together and see whether the company has actually cross-checked these invoices. If they have actually done, somebody has signed the documents with the dates, with the seal or anything, checked or reconciled or cross-checked, or that sign, that evidence should be there that they have actually cross-checked the documents. So you are testing it. You compare these sample documents and you check whether they have actually checked it. Review the use and authorization of credit memoranda. Now, in an organization, when you have credit sales, they have limits. They have limits, individual limits for individual customers sometimes. If they have long-term customers with good relationships, credit limit would be higher compared to new customers. Likewise, if you just check whether the company is actually following their thresholds, whether they are actually giving the right amount of credit to the right people. So you can pick few creditors, or means the debtors, and then see whether they are in the right credit limit, whether they have exceeded it, whether these credit limits have been approved by the directors or the relevant personnel. Likewise, you are checking. Reconcile selected cash register tapes and sales tickets with sales journals. Basically, whether the cash receipt is already there for the sales cash transactions. Test IT application controls. Sometimes in the sales system, there can be password protections, there can be different access controls. Likewise, you are checking those IT application controls are there. Whether all the people in the finance department can access to sales system. Likewise. Examine evidence of review and approval of revenue estimates. If the company has made estimates, whether the approvals have been given for those estimates, whether they have actually budgeted correctly. If necessary, revise the risk of material misstatement based on the results of the test of controls. Now, after testing the controls, if you feel like there are so many errors, there can be so many frauds, there can be so many issues in this revenue caption, sometimes you will have to revise the risk of material misstatements and do more audit procedures, right? Okay, now there's a table again relating controls to assertions. Now, if you take this one control, what is that first control? Segregate duties, okay? Segregate duties over sales and collection of receivables. That means you have to have 2 or more people in the process of recording the sales, or taking the customer orders and then finalizing the customer order, contacting with the warehouse and then issuing the goods and the collection of receivables and the cash receipt process, finalizing the invoice and getting the cash. So during that process, you need to have multiple personnel. That means you have to have more than one person in this process. You segregate, you allocate different small tasks to different people. What is the typical test of control now? Now, this is the control. This is the control. Now, this control is there in the organization. Observe and make inquiries about the performance of various functions. You go and observe whether actually this process is happening. You inquire with the personnel, or you may inspect. It is not there. You may inspect the documents again. So when you actually inspect, sometimes you can identify the different signatures and all, right? So this is the test of control. This is the control. This is the test of control. Now, for each and every test of control, what is the assertion you are going to complete? Existence and occurrence. Now, if you take existence and occurrence, this is not one assertion. As you know, existence is one, occurrence is one. Existence is related to trades and other receivables. Occurrence is related to revenue. When you get these two, the selected or the topics we are discussing. So if you take both, since we are taking revenue, occurrence should be there. Since we are taking trade receivables, existence should be there. That's why these two values are in one. Here, valuation and accuracy. Accuracy, you relate it to P&L items. That means revenue. Valuation, you relate to statement of financial position, balance sheet. That means trade receivables. Since we are talking about both, we have taken it as one column, right? That's why. Otherwise, you will misunderstand. These are not the same one, but related one. So when you actually observe, when you do this test of control, you can verify whether the occurrence is there for revenue transaction, whether the debtors are actually existing. Maybe completeness. You can check whether the completeness is there. You can identify the rights and obligation, whether the company has actual rights over the debtors, because you are checking the documents. Since you are checking the documents, you can check the accuracy of the invoice. You can check the accurate valuation of the debtors. Likewise, certain assertions can be covered using this test of control. Take the second one. Match sales invoices with shipping documents, purchase orders, and sales orders. Purchase orders means the order you are receiving from the customer. From their perspective, it is a purchase. So we are receiving a purchase order. Based on the purchase order, we are preparing the sales order and then the shipping documents and the invoice. So I told you sometimes we call this three-way matching. Three documents are there, three-way matching. So it is the control. It is the organization's control. They are doing it. What is the test of control? Select a sample of sales invoices and compare details to shipping documents, purchase orders, and sales orders. You select a sample and you check whether you compare the details with these documents. So maybe you can verify the occurrence, cutoff. When you actually check the documents, you can see whether the transaction has recorded in the correct accounting period, whether the debtors are actually owned by the organization, whether the values are correct. Likewise, you can cover these assertions. Review of the clerical accuracy of the sales invoices by a second person. You just calculate, not you, company personnel, just review the accuracy of sales invoices, mathematical accuracy, and the information accuracy. Select a sample of sales invoices and examine them for evidence of second person review. So how are we going to check whether that second person has actually reviewed the document? There should be at least a signature. There should be at least a seal or date or checked or reviewed by this person. That evidence should be there. If that evidence is missing, no one can claim that this invoice has been reviewed, right? So that evidence should be there. So you are going to see whether that evidence is there, whether that second person review seal second person review signature is there. They have put some small ticks. Sometimes they might be using a different color for that. Likewise, you know the process and then you see whether that process has actually happened, right? So when you check the sales invoice, basically that means the accuracy of the revenue transaction, and on the other hand, valuation of the trade receivables, right? It is a double entry, no? Accuracy of revenue transactions, valuation of the trade receivables. You are going to check it. Obtain credit approval of sales prior to shipment. Again, this is another control, getting the credit approval. So you are checking, make inquiries about the credit policies, select a sample of sales transactions and examine the evidence of credit approval. So you pick a sample and you see whether that credit approval has been actually given, whether this is approved by the credit control of the organization, whether that signature is there, whether that seal is there, that evidence should be there. So you're going to go for that signature, right? Likewise, mail monthly statements to customers and follow up on errors reported. That is their process. So how are you going to test it? Observe and make inquiries about the mailing of statements and review evidence of follow-up. Sometimes you can get the follow-up evidences and then copies of the letters sent. Likewise, you collect evidences whether that control has actually happened. Likewise, you have another part. This one also, you can identify what are the controls and what are the test of controls. So likewise, you have these controls, maybe reconciling bank accounts monthly, using control listing for control cash collections, use budgets and analyze variances from actual amounts. Likewise, controls are there. Related to those controls, how are you going to really test those controls? Test of controls are also there. So likewise, you can read and understand these controls and test of controls. And now, when it comes to substantive tests, perform further audit procedures. Coming under that, you perform test of details and substantive analytical procedures. So what are these substantive tests, right? Maybe obtain an aged trial balance of the trade's accounts receivable and analysis of other accounts receivable and reconcile the ledgers. That means basically you can prepare aging analysis, debtor aging analysis. So I'm showing you one example for that. Aging analysis, your aged trial balance is something like this. You have these customers, you have your debtors, that means debtors means based on the credit sales. You have these debtor names, and then you can mention the total receivable balance. This is $62,456, this total receivables balance. And now you have baskets. You have baskets. Now there can be different baskets in different organizations. In this example, you have 1, 2, 3, 4 buckets, 4 baskets. First basket is the current, and then past due 1 to 30 days. That means your debtor balance is older for 30 days, 1 to 30 days. That is 30 days bucket. And then 31 to 60 days. That means basically your debtor balance is more older for more than 1 month, but 1 to 2 months. Again, past due 61 plus days. That means 3 months, no? 2 months, no? So that means older than 2 months. That means you are allocating your debtor balances for each and every bucket based on their age. How many months older compared to different buckets. So here 62,000, 59,121 balance that is coming under current bucket. That means this is a very new balance. This is not much older, very new balance. But 3,335, that is 1 month old. 1 month old. That means you are putting it into 1 to 30 days bucket. But look at extreme company. Total balance is $18,000. It is not in the current bucket or the 1 to 30 bucket or 31 to 60 bucket. That is more than 2 months old. 18,210 is a very old balance. Likewise, you categorize your balances based on different invoice dates. කොච්චර oldද කියලා කොච්චර පරණයිද කියලා අපි මෙහෙම allocate කරනවා. That's the meaning of this aging analysis. So basically you can obtain that aging analysis and then reconcile. Confirm receivables with debtors. Basically you can call confirmations from debtors and get confirmations. We discussed that process in detail. Review the year-end cutoff of sales transactions. Basically, you can do the cutoff testing. This one also I explained. You can take 10 invoices, the last 10 invoices of 2024, and then the first 10 invoices of 2025. That means 31st December 2024, 10 invoices, last 10 invoices. The year starting with 1st January 2025, the first 10 invoices. And you check all these 20 invoices and check their dates in the invoices, and then you check whether the invoices have been recorded in the correct accounting period, whether it is in 2024 year or 2025 year. This is the cutoff test. We have discussed this in detail, right? So you can do that cutoff testing. Perform analytical procedures for accounts receivable and revenue. So I explained very well how you perform the analytical procedures for revenue, isn't it? Review significant year-end sales contracts for unusual terms. Now, when you go through the sales listing, you can identify with the values or with different amounts or with different names. Unusual term contracts can be there. So you review those significant year-end sales. Why year-end sales? There's a probability there can be fictitious sales transactions recorded in towards the end of the year end, just to increase the sales, just to increase the sales targets, just to meet the bonus targets. Likewise, you can have significant year-end sales contracts. So you are going to review them. Test the valuation of receivable, computation of interest income, interest receivable, and everything. Basically, you can recalculate all these calculations, get the supporting documents, and get the interest rates verified. You get the calculations correct. Evaluate the propriety of the client's accounts method for receivables and revenue, whether the company is following SLFRS 15 accounting standard and everything. Evaluate accounting estimates. Determine the adequacy of the client's allowance for uncollectible accounts. Basically, the impairment of trade receivables. You have to recalculate the impairment for trade receivables and see whether the assumptions they have used are okay, whether the rates they have used are fine, are they verifiable, whether they have done the correct calculation. Likewise, you can do the recalculation and see. Ascertain whether any receivables have been pledged. If it is pledged for different other factors, you need to mention them. Investigate any transaction with or receivable from related parties. Now, there can be related parties in organization. Subsidiary companies can be related parties. Now, if the transactions are related to related parties, you need to separately identify them under related party notes. There should be notes, separate notes. So debtor balances can have these related party balances as well. So you need to categorize them correctly. Classification. Evaluate the business purpose of significant and unusual sales transaction. Evaluate financial statement presentation and disclosure. Likewise, we can list many substantive testing, test of details, and substantive analytical procedures. Right. And then, so likewise, we have given the figure taken from the original document we have uploaded. What are the substantive procedures we can perform, and what are the assertions we are going to cover using those substantive analytical procedures, further audit procedures, not only substantive analytical procedures, all test of details and substantive analytical procedures, substantive procedures. Obtain age listing of receivables, confirm receivables with debtors, perform analytical procedures. Likewise, we discussed those substantive procedures And then what are the related assertions? Okay. And then confirmation of receivables, basically calling external confirmations from debtors. Receivables should be confirmed unless accounts receivable are immaterial. If it is a very immaterial balance, you may not call for external confirmations. The use of confirmations would be ineffective. That if even though we get the confirmation, that use of those confirmations would be ineffective, because with the past experience, most of the time debtors are not just verifying the balances, they are just replying for the sake of replying. So no point of taking. There were so many errors last year as well. So with that experience, maybe use of confirmations would be ineffective. Or the auditor's combined assessment of inherent and control risk is low, and the audit risk can be reduced to acceptably low level with the substantive test. If you can get the things done with other substantive testings rather than calling confirmations, maybe you can not call. You can avoid calling external confirmations. And then the process. Actually, we discussed roughly the process. See, the account balance is there. Confirmation request to ABC company prepared. CPA determines confirmation request is directed to appropriate confirming individuals and address. Confirm request delivered to ABC company. After determining all the addresses and everything, your confirmation request is delivered to the debtor company, ABC. ABC company receives the request. ABC company confirming that confirming party receives and responds to confirmation request. Response is delivered to auditors. Remember, confirmation request. After that, the reply from the confirming party should be directed to auditors, not the client. And then CPA receives response to confirmation request. So this is how you get it. And then the types of confirmations I'm not going to explain again here, because we discussed in detail positive confirmations and negative confirmations, right? If we are not if we ask the confirming party to reply, if they don't agree or if they disagree with the balances, that is negative, right? Positive confirmation means we are asking the confirming party to confirm whether they agree or disagree. Anyway, they have to reply, right? If we are not receiving a reply for negative confirmation, that means we consider it as they agreed for the balance, right? So I told you in Sri Lankan context what is the most suitable confirmation type. And then, of course, data analytics. Now, we can't do audit without these computer assisted auditing techniques. Now, there are so many data analytics techniques we can use for the purpose of doing the audit, especially when it comes to large number of transactions. If you have so many large number of transactions, and then we can definitely use data analytics, right? Basically, to identify possible fictitious revenue by searching unusual large entries, and they can easily capture using basically using AI. Identify possible fictitious revenue by searching for entries into revenue accounts from unusual sources. That also we can capture using data analytics. Identify possible revenue cutoff errors by examining unusual revenue transactions around year end. Identify related party transactions in the sales journal by selecting unusual transactions. Identify possible duplicate billings. Basically, you can identify the duplicate billings. Unauthorized sales discounts, because if we just apply a formula, not only basic Excel functions, but different complex data analytics softwares are there. So say if we educate that software, these are the discounts, these are the limits. Likewise, then they can capture unusual or unauthorized discounts given. Possible uncollectible amounts using, they can analyze the past trend of getting the balances collected from these customers. So based on their past behavior, these analytical softwares can predict the uncollectible amounts in future, right? Large credit balances, likewise, you can compare and you can identify these things. And then, of course, potential revenue recognition problems. What are the problems? Sales with unusual right to return. Now, if the customer is having an unusual right to return the goods with the terms of the revenue contract, potential revenue recognition problems can be there because we don't know the point. We don't know means we have to definitely identify the exact point where the revenue can be recognized. Bill and hold transactions can be there. You bill, you get the invoice, but holding the goods, maybe until they satisfy a certain condition. Likewise, now when they have transactions like that, you have to be very careful at which point you can recognize the revenue. Multiple element agreements, if the agreement has multiple elements to be satisfied, you need to identify, you need to understand what is the point we are going to recognize the revenue. And evaluating revenue estimates, of course, that is also important. There can be significant accounting estimates involved. So auditors can evaluate these estimates by reviewing and testing management methods. Now, what is the method used by the auditors, the management to develop the estimates? And then, of course, auditor can develop our own estimate based on the numbers they are using, and then reviewing the subsequent transactions and other events. So when you review the subsequent transactions and events, you can identify whether the estimate is correct, right? Likewise, and then the auditors are required to perform a retrospective review of the prior year's significant accounting estimates to determine whether they indicate bias on the part of management. Likewise, you can evaluate the revenue estimates. And then when it comes to doubtful accounts, allowance for doubtful accounts, basically impairment of trade receivables, review collections in subsequent period, develop estimates, compare the details of the aging of accounts receivable to prior year aging, investigate the credit ratings of these large accounts, and then review confirmation exceptions for an indication of amount of dispute. When you have call confirmation and if there are exceptions, you are reviewing the reasons. Summarize in a working paper those accounts whose collectability is doubtful based on the preceding procedures. Review with the credit manager the current status of the significant doubtful accounts. Now you can ask from the credit manager, who are the difficult customers? What is your estimate on the allowance for doubtful accounts? Who are the doubtful customers? Likewise, you can do different audit procedures. Now here we have given you a very small sample of this bad debts calculation. So as you can see, this is the aging analysis. Customers are there, total balance is there, and then we have used buckets. Now, as you think, what is the most riskiest bucket, I would say? Current bucket or the past due 61 plus days bucket? Definitely the riskiest bucket is this one, right? The last bucket, because those balances are very old. So we don't know whether we will be able to collect these balances, right? Because the balances are very old. So when you provide for doubtful debts, when you provide for bad debt, not actually bad debt, provision for bad debt means allowance for doubtful debts. The actual name we are now using is the impairment, right? Impairment of trade receivables. Now, what is this? Percentage, look at the percentage. 18,210, you are applying 50%. There's a 50% high chance that we are not going to receive this balance. So you are providing for 9,000. But if you take the previous bucket, $1,200, it is only 20% chance. The next one, the one before the 31 to 60 days bucket, that means 1 to 30 days, only 1 month older. That is only 10%. 10% chance that we are not going to collect these amounts. Likewise, you increase the rate when the balances are getting older. This is a very simple calculation. Actually, the actual calculation is way more complex than this. But just to give you an idea, the concept of calculating provision based on the aging analysis, this is how you do it. So taking the total 9,679, you can calculate it. right? This is our calculation. Now, what is the client's calculation? This is what we calculate using the numbers. Then what is the client's calculation? Client has calculated only $5,000, whereas the auditor calculates independently. This is basically a recalculation. It is 9,679. So definitely additional provision is required. A journal entry needs to be passed for the balance 4,679. So this is how you do. Client's number, your own number, auditors calculation, and then you compare, and then you ask the management to pass a journal entry for this balance. Right. So this is the remaining part. Actually, we completed it. Now, actually, this we have selected sales, that means revenue, and trade receivables, just to give you an idea, just to take you through the process of doing the audit of these two captions. So you can understand, you can read the documents uploaded into the LMS, not actually by hearting everything, but just read and get an understanding how you apply these methods to other captions as well. That is important. Right. So with that, I'm finishing this recording now. Thank you very much.